Assalamualaikum warahmatullahi wabarakatuh. My name is Wana Ali Sofia binti Warosli. So, my group will present about the San Francisco and Starbucks company financial ratio analysis. So, the main point of the introduction is to express gratitude and appreciation to the individuals who contribute to the completion of the principle of finance assignment. These assignments highlight the importance of financial principle in managing money and making informed financial decision. It's also acknowledged the support and mentorship provided by Madam Nur Safida, which significantly influenced the team initiative. We also understand the value of working together in teams, and we appreciate the assistance of our classmates and lecturers during this journey.
Hello, my name is Tasnim Aisha binti Idris, and I will continue to describe the company background of Starbucks based on what we have researched in the internet. Starbucks, the world's largest coffee house chain, boasts a rich history dating back to 1971. Here's a glimpse into their background. The founding is established in Seattle's Pike Place Market by three coffee enthusiasts who are Jerry Baldwin, Gordon Booker, and Zeph Searle. The name, inspired by Moby Dick, evoked the seafaring heritage of coffee traders. For the early years, they focused on selling premium roasted coffee beans, tea, and spices. Howard Schultz, a key figure in Starbucks' future, joined the company in 1982. And for shifting gears, it's inspired by Italian coffee culture. Scotch encountered in Milan, Starbucks transitioned from a bean retailer to a coffee house serving espresso-based beverage in 1987. This marked a turning point for the company. Furthermore, under Scott's leadership, Starbucks embarked on an aggressive expansion strategy, first across the West Coast and then throughout the United States and abroad. They opened their first stores in Japan, Europe, and China. And today, Starbucks is a global phenomenon with over 35,000 stores in 80 countries. They remain a leader in the coffee industry, known for their signature beverage, comfortable atmosphere, and commitment to ethical sourcing. Then, let's move on to the ratio analysis of Starbucks.
My name is Siti Nur Fatiha. We move to liquidity ratio for Starbucks. The first one is current ratio. Current ratio from current asset divide current liabilities. Based on the calculation, the company's current ratio has decreased from 2019 until 2021, and then in the year 2022, it increased. However, in 2023, it decreased from 0.44 in 2022 to 0.33 in 2023. It indicated a slight decline in short-term liquidity. This company may have taken on one more short-term, such as account payable. Second is quick ratio. Quick ratio is current asset minus inventory divide current liability. Starbucks current quick ratio show in 2019 to 2022 show decreased value from 0.15 to 0.13. After that, it showed no changes in 2021 and started to increase in 2022. The amount decreased from 0.31 in 2022 to 0.22 in 2023. This indicates a potential decline in the company's short-term liquidity and raises concerns about their ability to pay upcoming bills without relying on additional financing or selling favor liquid asset. The higher quick ratio is better, which is in the year 2022. Last liquidity ratio is cash ratio. Cash ratio from cash divide current liabilities. Based on the calculation, from 2019 until 2022, it showed an increase in cash ratio. An upward trend indicates an improvement in the company's ability to meet short-term obligation. However, for the year 2022 and 2023, it showed a consistent cash ratio that suggests Starbucks is maintaining a steady level of liquidity. This could be positive if the ratio itself is within a healthy range for the industry. We continue to leverage ratio. The first one is debt ratio. Total liabilities divide total asset. Starbucks debt ratio indicates the percentage of firm asset that are financed by debt. A low percentage means that the company is less dependent on leverage, which is in the year 2019. It showed that in 2021, they have a higher debt ratio compared to other years. The higher ratio means they have more risk. Next, debt to equity ratio. Total debts divide total equity. Based on the calculation, to compare the years 2019 and 2023, it indicates that it is increased from 2019 to 2020 in the value of 0.78 to 0.93. It decreased in 2022 from 0.93 in 2022 to 0.76 in 2021 and 0.42 in 2022. It increased back in 2023 in 0.49. This is suggests that Starbucks is paying down debt, possibly due to strong cash flow or strategic decision to reduce risk in 2019 to 2022. But to compare year 2022 and 2023, it showed an increase in debt to equity ratio. Starbucks might be taking on more debt to finance growth. Times interest earned, EBIT divide interest expenses. Based on the calculation, Starbucks time interest earned has declined in 2023 if compared to 2022. It shows that Starbucks is struggling to cover its interest payment. The higher time interest earned is better, which is in year 2022. The times interest earned ratio reflect the number of time before tax earning cover interest expenses, and it is used to determine how easily a company can pay interest expenses on outstanding debt. The last one is cash coverage ratio. EBIT plus depreciation divide interest expenses. Based on the calculation, it should decrease from 2019 to 2020 in amount 5.5 to 1.48. After that, it should increase until 2022 from 1.48 to 3.48 and 8.83. The year 2022 has higher cash coverage ratio compared in 2023. The higher is better because it indicates a company's ability to generate cash from operation to meet its financial obligation.
Bismillah, my name is Muhammad Shakir. So I will continue the presentation about the asset management ratio for Starbucks. The first ratio that will be calculated is inventory turnover, which cost of goods sold will be divided with inventory. As you can see here, from 2019 to 2021, there is a decreasing in the ratio, which from 11.87 to 8.66 and from 8.66 to 7.63. But for 2023, their inventory turnover is better than the previous year, which is 2022. This means that Starbucks sold and restocked the entire inventory about 10 times during the year 2023. This could indicate positive development like improved sales with similar inventory levels that leading to faster stock turnover. So for the next ratio is days sales in inventory, where 365 days will be divided with inventory turnover that just been calculated. As we can see here, among the 5 years, 2019 shows that they only need 30 days to sell the product, which means Starbucks is selling through its inventory faster. This means that they are tying up less money in holding inventory and potentially reducing storage costs. It could be also suggest strong customer demand for their products. For the next ratio is receivable turnover, which sales will be divided with account receivable. As we can see here, Starbucks receivable turnover in the year 2022 has a lower ratio compared to other years. This indicates a decline in efficiency in collecting payments from customers. Perhaps customers are taking longer to settle their invoices that leads to build up of account receivable. But for 2023, it got the highest ratio between the 5 years, which means a good receivable turnover compared to other years. The amount of the 2023 ratio is 34.83. For the next ratio is days sales in receivable, where 365 days will be divided with the receivable turnover ratio. As you can see, the calculation in the year in the year 2022, it indicates that customers took an average of 20 days and an average of 10 days during 2023 to pay for their credit purchase. In 2023, it shows a positive sign because it has improved in collection efficiency. Starbucks is collecting payments from customers faster, which means it's converting credit sales into cash quicker in 2023. But in 2022, it shows a decline in collective efficiency, which means the credit sales into cash is lower than 2023, which means it take longer to collect payments. Okay, for the last one on asset management ratio, where total assets turnover is when sales will be divided with total assets. The total asset turnover ratio relates sales to assets. It is called the management efficiency ratio because it indicates how well a company been using their asset to generate revenue. Based on the calculation above, the year 2019 has a higher ratio compared to other years. It shows a positive sign because it is utilizing its asset to generate revenue. An increase from the year 2022 to 2023 also shows a positive use of asset. It indicates Starbucks is generating more sales per dollar of assets in 2023 compared to the previous year. That's all for the asset management ratio. I will pass the presentation to the next presenter.
Assalamualaikum warahmatullahi wabarakatuh. So today I will present about the profitability ratio for the Starbucks. So for the first one is profit margin. To count the profit margin, we need to take the net income divided by sales. As you can see in the table, for 2019, the total profit margin is 0.03. For 2020, the amount is negative 0.03. For 2021, the amount is 0.027. For 2022, the amount is 0.12. And for 2023, the amount is 0.09. As you can see on the graph, Starbucks profit margin has decreased from 2019 to 2020, and it started to increase until 2022, and starting from 2022, it decreased from 0.12 to 0.09. So A decrease in profit margin could indicate that the company is becoming less efficient at producing and selling its goods. It could be also a sign that Starbucks is facing increased competition. So, the second one is return on asset. To count return on asset, we need to take the net income divided by the total asset. As for the table, you can see at 2019, the amount is 0.03. 2020, the amount is negative 0.02. 2021, the amount is 0.04. 2022, the amount is 0.09. And for 2023, the amount is 0.07. So this is the graph for the return on asset. Return on asset ratio indicates how profitable a company is relative to its total assets. Starbucks on assets decreased from 0.09 in 2022 and to 0.07 in 2023. This indicates a decline in the company's efficiency in utilizing its asset to generate profit. So, the third one is return on equity. To count on return on equity, we need to take the net income divided by the total owner's equity. As you can see here, for 2019, the amount is 0.07. For 2022, the amount is negative 0.06. 2021, the amount is 0.12. For 2022, the amount is 0.25. And lastly, for 2023, the amount is 0.21. This is the graph for the return on equity. Starbucks return on equity decreased from 0.25 in 2022 to 0.21 in 2023. This indicates in 2022, Starbucks is generating a better return on its shareholders' equity compared to 2023. A higher return on equity generally implies the Starbucks is more efficient in using shareholders' equity to generate profit.
So now I will continue to present to you about market book value ratio. So how to get the market book value ratio? First, we get the net income and we divide by the number of outstanding shares. So as you can see the table, earning per share decreased from 0.31 in 2022 to 0.05 in 2023. It indicates that in 2022, Starbucks profitability is growing relative to its outstanding amount, but the decrease in 2023 is because by the falling revenue, declining profit margin, or increase in outstanding share. So the second one is I will present to you about the price to earning ratio. So how we can get the amount is we take the price per share and we divide the earning per share. So as you can see, based on the calculation, Starbucks price to earning ratio is increased from 2.13 in 2022 to 2.6 in 2023. It could be because the investor is willing to pay a higher amount premium for each dollar of earning. It could anticipating in future growth of company. So now the third is price to grow ratio. So as you can see from the table and the graph, in 2029 it shows 6.80, and in 2020, 2021 and 2022 it shows increase from negative 0.5 to negative 0.3 and 0.01. In 2023 it should decrease back to negative 0.03. Starbucks price per earning to grow ratio has negative earning that indicate Starbucks might be financially unstable. This could be from the increase of operation, increase of competitor, and efficiency of operation. So the last one is market to book value ratio. So as you can see from the table and the calculation, market to book value more than one indicates that the market value is higher than the book value. indicating the investor believe that the company is worth more than its net assets. Based on the calculation above, in 2023, it decreased from 3.3 in 2022 to 2.2 in 2023. The decline could be because of the investor confidence. This could be due to slowing growth and negative news that lead to a decrease for industry economies.
So now I will explain the company background of San Francisco Coffee. San Francisco Coffee is a Malaysian company founded in 1997, focused on providing a delightful coffee experience. So this company established in 1997 in Petaling Jaya, Malaysia. Their mission from the beginning was to provide coffee lovers with the freshest and the highest quality coffee. The next one is focus on freshness. They prioritize hand roasted coffee to deliver a superior coffee experience. And the last one is growth and ambience. Over the past 2 decades, they have expanded their presence while maintaining a focus on creating a pleasant atmosphere for customers. Their cafe aim to engage all five senses with lively surroundings, soothing music, and of course aromatic coffee.
Hi and Assalamualaikum. My name is Balkis binti Jamsuddin. So today I would like to present to you guys liquidity ratio and leverage ratio of San Francisco company. So for the first cash ratio, as you can see here, based on the calculation, San Francisco has better liquidity and short-term solvency in 2019, which is 0.95. So now let's take a quick look at San Francisco quick ratio trend from 2019 to 2023. In 2019, the ratio stood at 0.61, indicating a relatively healthy short-term liquidity. However, this number dropped to 0.42 in 2020, showing a decrease in the company's ability to pay its upcoming bills. In 2021, we saw a slight improvement, but this was followed by another decrease in 2022. Fortunately, by 2023, the quick ratio rose to 0.55, showing a positive trend. Based on the calculation, in 2019 to 2021, it showed that it decreased in cash ratio. After that, it started increasing, and unfortunately, in 2023, showing decreased value from 0.079 to 0.074. This indicates that the ratio show that it is not good for the company. So now we move to debt ratio. San Francisco debt ratio indicate the percentage of the firm's assets that are financed by a debt. A low percentage means that the company is less dependent on leverage, which is in the year 2019, it showed that in 2021, they have a higher debt ratio compared to other years. The higher ratio means they have more risk. Based on the calculation, time interest earned has increased in 2019 until 2022, but declined in 2023. It showed that San Francisco is struggling to cover its interest payment. The higher times interest earned is better, which is in year 2002. The time interest earned ratio reflects the number of time before tax earning cover interest expenses, and it is used to determine how easily a company can pay interest expenses on outstanding debt. So based on chart, cash coverage for 2019 is the higher. It shows that the revenue can cover our interest and expenses for the year. Meanwhile, in the upcoming years, the coverage is in increased flow.
Assalamualaikum. My name is Muhammad Ali Faikal and I will explain about asset management ratio for San Francisco. Asset management ratio are critical indicators of how efficiently a company utilizes its asset. For San Francisco Coffee, the primary asset management ratio discussed in the document is the inventory turnover ratio. This ratio measures how many times a company's inventory is sold and replaced over a period, indicating the efficiency of inventory management. Based on this calculation, San Francisco Coffee had the highest inventory turnover ratio in 2022 at 6.52, indicating that they sold and restocked their inventory approximately 6.5 times that year. This suggests efficiency inventory management for that period compared to the other years. Another related measure is the days sale in inventory, which estimate the average number of days it takes to sell the entire inventory. The days sale inventory ratio indicates that in 2022, it took San Francisco Coffee about 56 days to sell their inventory, the lowest among the years analyzed, which again suggests better in inventory management performance in that year. The days sales in receivable for San Francisco Coffee indicates the average number of days it takes for the company to collect payment after a sale has been made. This metric is essential for assessing the efficiency of the company's credit and collection processes. The analysis reveals that 2023 had the best performance in terms of DSR, which customers taking an average of only 38 days to pay their credit purchases. This improvement suggests enhanced efficiency in the company's credit management practice compared to previous year. For receivable turnover measure how efficiently a company collect its account receivable. It is calculated by dividing net credit sales by the average account receivable. This ratio indicates how many times a company can turn its receivable into cash during a period. In 2023, San Francisco Coffee had the highest receivable turnover ratio of 9.57, indicating the company was more efficient in collecting its receivable compared to previous year. Lastly, total asset turnover measure how efficiently a company uses its asset to generate sales. It is calculated by dividing net sales by average total asset. This ratio indicates how many dollars of sale are generated for each dollar of asset. In 2023, San Francisco Coffee achieved its highest total asset turnover ratio of 0.996, indicating that the company nearly generated $1 of sale for every dollar of asset. This improvement suggests increased efficiency in using asset to generate revenue compared to previous year. So overall, 2023 marked a year of improved efficiency in asset management for San Francisco Coffee, with better performance in inventory receivable and total asset utilization.
Assalamualaikum warahmatullahi wabarakatuh. My name is Noor Natasha Binti Hassan and I will present to you about profitability ratio. Profitability ratio such as net profit margin, return on asset, and return on equity measure a firm effectiveness in turning sales or asset into profit. Ultimately, what we want to know is how well the company has generated profit and performed overall. Firstly, for the profit margin indicate the profitability generated from revenue and hence is an important measure of operating performance. It also provides clues to a company pricing cost structure and production efficiency. Profit margin can be calculating by dividing net income by sales. San Francisco profit margin has increased from 2019 to 2020 and decreased from 2020 to 2022. A decrease in profit margin could indicate that company is becoming less efficient at producing and selling its goods. It could be a sign that San Francisco is facing increased competition. The data indicate a trend of fluctuating profit margin over the 5 years. The worst year was 2020 with a significant drop in profit margin to negative 0.25. There was a recovery in 2021 and a notable improvement in 2022, nearly reaching a break-even point. However, 2023 saw a decline again, although it was not as severe as in the early years. The company struggled to maintain a positive profit margin throughout this year, experiencing significant variation in financing performance. Secondly, return on asset ratio (ROA) indicates how profitable a company is relative to its total asset. ROA can be calculated by dividing net income by total asset. This indicates that a decline in the companies of SF Coffee in its asset to generate profit because of the net loss from 2019 to 2023. The data show a trend of fluctuating ROA over the 5 years. The worst years was 2020 with a step decline in ROA to negative 0.14, indicating the least efficient use of assets. There was an improvement in 2021 and a significant recovery in 2022, nearly reaching break-even performance. In 2023, the ROA declined again but was better than the level seen in 2020 and 2021. The company has struggled to achieve a positive ROA, experiencing significant volatility in asset utilization efficiency over these years. Lastly, return on equity ratio (ROE) indicates how profitable a company is by comparing its net income to its average shareholders' equity, and to measure how much the shareholder earn for their investment in the company. ROE can be calculated by dividing net income by total owner equities. San Francisco return on equity has negative amount from 2019 to 2023 because of the net loss. The data show a trend of fluctuating ROE over the 5 years. The worst year was 2020 with a step decline in ROE to negative 0.48, indicating the least efficient use of equity. There was an improvement in 2021 and a significant recovery in 2022, nearly reaching break-even performance. In 2023, the ROE declined again but has better than the level seen in 2020 and 2021. The company struggled to achieve a positive ROE, experiencing significant volatility in equity utilization efficiency over these years. To conclude, across all three metrics, profit margin, ROA, and ROE, the company faced significant financial challenges, particularly in 2020, which marked the lowest point. Although there was improvement in 2021 and substantial recoveries in 2022, the company struggled to maintain consistent positive performance. The year 2023 saw decline again, suggesting ongoing volatility and challenges in achieving stable financial health.
Warahmatullahi wabarakatuh, and my name is Ansha Umair Abeti Abdullah. I will present about the market value ratio. So for the first one is earning per share. Earning per share for the last 5 years are negative because of company had net loss. And for 2020, higher loss after current issue for COVID-19 are in process of improvement in market of business. Next is price to earning ratio. Price to earning ratio for the year 2019 and 2020 is negative because of the lost income of the company, while for the year 2021 and forward are positive even though company is still lost. For the third point is price or earning to growth ratio. Price to growth ratio is higher in 2023 because the price per share for the year is RM 10 ringgit 9 cent, which is the higher price in the last 5 years. For the last point is market to book value. Market to book value, more than one indicate that market value is higher than the book value, indicating investor believe the company is worth more than its net asset. Based on the calculation above, in 2019 has the higher market to book value, while in 2022 was the lowest. A decline could signal declining investor confidence. This could be due to slowing growth, negative news, and industrial headwinds. So that's all from me. Thank you.
So now I will present about the recommendation of the San Francisco company. First, improve profitability ratios. San Francisco needs to focus on improving its profitability ratios, particularly the profit margin, which has decreased in 2023 compared to 2021. They need to become more efficient at producing and selling their goods. The next one is analyze return on asset and return on equity. San Francisco should analyze their return on asset and return on equity ratios to understand how effectively they are using shareholder investment and total asset to generate profit. The recommendation indicates a decline in this ratio which need to be addressed. And the next one is strategies to increase sales volume. To improve profitability, San Francisco should focus on strategies to increase sales volume, such as marketing campaign, new product offering, or entering new markets. The next one is cost reduction strategies. In addition to increasing sales, San Francisco should look for ways to cut costs without sacrificing quality, such as renegotiating with suppliers, streamlining operation, or minimizing waste. The next one is optimize asset efficiency. San Francisco needs to optimize its asset efficiency by improving inventory management, reducing waste, and utilizing equipment more effectively. And the last one is develop a long-term strategy. To improve return on equity, San Francisco should develop a long-term strategy that incorporates multiple approach for sustainable return on equity growth, considering qualitative factors like management effectiveness, brand reputation, and market competition. So the main thrust of the recommendation is for San Francisco to focus on improving its financial performance, particularly its profitability and efficiency, through a combination of sales growth strategies, cost reduction initiative, and long-term strategic planning.
For the recommendations for Starbucks, based on from the overall financial ratio analysis for 5 years from 2019 until 2023, we can conclude that several factors that affect ups and downs in Starbucks operations. First, to remain and sustain in the market, Starbucks should do better in reinvest their profit to retain future growth. They also need to identify how to stack up against its competitors in terms of financial performance. Then, they must look for year-over-year changes in each ratio to understand how Starbucks' financial health is evolving. Additionally, Starbucks need to optimize asset efficiency by improving inventory management, reducing waste, and utilizing equipment more effectively. They need to improve return on equity next year by develop a long-term strategy that incorporates multiple approaches for sustainable return on equity growth. That's all the recommendations we can conclude here. In conclusion, financial statements are used in financial analysis to evaluate the performance, financial health, and prospects of a company. A company's financial health can be measured and assessed during a variety of methods, including ratio analysis, vertical analysis, and horizontal analysis. But the one we use to analyze these two companies is ratio analysis. Investors and stakeholders can use this analysis to make informed decisions about the financial health and performance of both Starbucks and San Francisco Coffee in the food and beverage industry in Malaysia. However, investors also should carefully assess the risk tolerance and investment objective before making decisions based on this analysis. Lastly, both companies have their own strengths to compete in the market, and that was when this analysis come to assist them on decision making. That's all from us. Thank you.